Hello options traders and welcome everyone. Well, if you're like most traders, you have at some time had the urge to embark on a short naked option selling spree. It's an easy strategy to want to fall into because on the surface it appears like a high probability strategy. And therefore it seems like free, easy money. And hey, who doesn't want that, right? But the problem is that there are a lot of risks with short options, the naked options, and unfortunately a lot of traders just never consider them. You've got gamma risk, you've got vega risk, liquidity risk. There's many types that can occur. But there's one in particular that most traders never consider. And the reason they never consider it is because they simply cannot see it. So let's start off by talking about naked options. What are they? Well, it's just an industry term that means you have a short, unhedged option. That's the key, is that it's unhedged. You can have a short option in the account and it might not pose a big risk. It's when it's unhedged that it becomes a problem. So for instance, let's say that you own 100 shares of Microsoft and you sell a call against it, what we call a covered call strategy. Yes, you have a short call in the account, but it's not naked. It's a covered call. That risk is covered because you currently have the shares in the account. Well, you can sell options all day long if you have shares of stock or maybe another long option against it, such as with a vertical spread or a diagonal spread. But if you sell an option all by itself, it's just hanging out there as a short, unhedged position. That's what we call a naked option. So if you sell a put option by itself, unhedged, it gives you the potential obligation to buy shares. If you sell a call by itself or a naked call, it gives you the potential obligation to sell shares. And yes, they might have a high probability for success, at least according to a pricing model. And that's how most traders make their decisions. But therein lies the problem. Traders use pricing models to determine the risk of selling naked options. And one of the things that they'll look at is what's called the options delta. And the options delta is the approximate probability for the option to expire in the money. So if it doesn't have a very high delta, well then pretty good chance you're going to sell this option unscathed and just collect that money, and you're going to do it week after week or month after month. So for example, let's say that the stock is currently trading right here at 100, and we might look at a $90 put, $10 out of the money. And we look at the pricing model and it says that it has a 15 delta. Well, that's roughly a 15% chance that that option will go in the money. In other words, there's an 85% chance that you're going to collect that premium and never have to pay out a dime. Over on the other side of the board, maybe we consider a 110 call, 10 points out of the money. And the pricing model might say that we have a 20 delta. So that's about a 20% chance that that option's going to go in the money, or 1 time out of 5. So again, looks like it's pretty low chance. Let's go ahead and start selling these options. But to further compound the problem is that these out-of-the-money options are usually fairly cheap. And also traders tend to sell them on low volatility stocks thinking that they're safer. So they might find that these options are only trading for 30 cents or 50 cents. So instead of just selling one contract for 50 bucks total, they sell 5 or 10 or 20, thinking again that it looks like free money. Well, where is the danger? Well, the danger again comes in from the pricing models. And you have to understand that option prices are ultimately determined by supply and demand, nothing else. Sure, traders will take a look at pricing models to assist with their supply or their demand decisions, but ultimately the only thing that matters is how many people do we have who want to buy and how many people are willing to sell. And as you probably know, emotions can take over during earnings, takeovers, and FDA announcements. Any type of big news can really cause traders to bid too high. They just say, I don't care what the price is, I just need to get in. And so they get into bidding wars without really realizing what they're paying for. The pricing models can't account for this. A pricing model can't account for, as Greenspan said, the irrational exuberance. How could you possibly put that into a model? And the problem is that we can get much larger price changes than a pricing model would suggest. And the reason this occurs is because of human emotions. So let me give you some examples. So for example, here's Walgreens, ticker WBA, and it's not a high volatility stock, at least by most people's definitions. Certainly not like the likes of Netflix and Amazon and Google's of the world. But what you're looking at here is a 1-year chart of the daily closing prices in terms of standard deviations, which is the stock's volatility. And as most of you probably know, most things occur within 3 standard deviations. It should be pretty rare that we ever see a stock's closing price exceed 3 standard deviations. And in fact, only 1 time through the year would we expect it to even hit 3 standard deviations. But take a look at what we have here. So to create this chart, what I did is I took the first 30 days and calculated the stock's volatility, came up with a number, and then we take the very next closing price and say, well, how big was that stock's closing price based on the previous 30 days volatility? And so that's what you're looking at on this first spike right here. And look at that, the first one in the chart, well above 4 standard deviations. Not too long after, more than a 6 standard deviation move to the downside. Look at this one over here, another 6 standard deviation move to the downside. Another one pushing 7 standard deviations. A 6 standard deviation mark should only occur once about every 1.4 million years, certainly not 3 times in the same year. So why does this happen? Are the pricing models wrong? Not at all. The pricing models are correct given their assumptions. That if the stock is trading at, let's say, 20% volatility, and it stays at 20% volatility, this is what the option is worth. But the model is not saying, well, therefore people are going to go out and spend that for it. They'll go out and spend a lot more for it. That's what you're seeing here. And it's not just Walgreens. It happens with every single one. Let me give you another example. Here's Ford, ticker symbol F, very low volatility stock, basically a $10 stock, doesn't have a lot of activity on it. Same idea here, and you can see that in the vast majority of the cases we stayed within 2 standard deviations. Looks like right here only 1 time through the year that we hit this 3 standard deviation mark, which is what you would expect. Except for this one right here, which was a 6 standard deviation mark, again, once about every 1.4 million years. Take a look at these out here in the wings. 8 standard deviations down and nearly 8 standard deviations up. It's getting almost impossible to calculate the probabilities out here, but it's going to be more in the order of probably once every 200 billion years you should see a move that big if stock prices actually followed a true normal distribution or a bell curve. So again, do they? Well, it doesn't matter if the stocks do or not. It's because traders can become overzealous in their bidding. And whenever there is big news, takeovers, earnings, lots of different reasons, you can see these stocks take exceptionally large moves. So the problem with selling the naked options is that the probabilities for devastating losses are probably much higher than a pricing model may suggest. So for all of you who are using or considering using naked option strategies, it's not the risks that you can see and calculate that you should focus on. It's the risks you don't see that matter most. And that's why it's so important to hedge those naked positions. For those who'd like to learn more about the art and science of options trading, please check out the brand new Strategy Lab for 2019 at optionsaToZ.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.